This is Anna and Rick with REIA, and today we're going to be talking with Michael Lorino about real estate assumptions and how we can do that. So, Rick, take it away with a quick intro.
Yeah, so Michael has a wealth of experience. First off, he's a military veteran, served for over 20 years with the Marine Corps, and he has been in real estate now since the housing crisis, 2009. So he's got some war stripes from all the short sales and all that was going on in 2010, 11, and throughout. And he's the founder and the CEO of Assume List. And what this is, and Michael, you'd be a better person to answer this, but you've researched it and you saw with rising interest rates that people are going to be more creative with assuming loans because they're basically grandfathered into these low interest rate loans, and that you saw an opportunity to try to match a buyers with sellers who might want to assume their mortgage. Is that pretty much it?
You got it. That's exactly right.
Awesome. So welcome, Michael.
All right. Is that my cue to kick it off? Am I jumping on stage
It
here?
is. That's your cue. You take it away.
Well, thanks, Rick, and thanks, Anna, for hosting. I very much appreciate the invitation. I think this has been kind of in the works now for a couple of months that we've been talking about doing this event, and I'm very excited to be here. I love talking about assumable mortgages. It is my niche. A good chunk of my business is tied to not only doing assumable mortgages myself, but also helping others, helping agents understand how they work, helping investors understand the rules to help them improve or increase their chances of success in doing these types of transactions. They are nuanced. It's not a standard typical transaction. There's certain rules that apply specifically when we talk about using assumable mortgages for investors or investors purchasing these homes. And so we're going to get into the details and nuts and bolts. Just a quick 30-second background. So I've been in real estate for, 16 years now. I got my license, as Rick mentioned, 2009. 20-year career, Marine Corps officer. You can see behind me, always got that Eagle, Globe, and Anchor here behind me. And good chunk of my business, I live up in Northern Virginia in Alexandria. And as you would imagine, just recently retired about 3 years ago. So a good chunk of my business is still serving the military community. So I get a lot of military families who are looking to purchase homes in Northern Virginia. And I run a team here based out of Old Town Alexandria. And about 2.5 years ago now, when rates started spiking, if you recall, post-COVID, we had for years and years and years, these 2.75% interest rates where everybody was just getting a smoking deal on their mortgage. And then when interest rates of the Fed started raising the federal funds rate, of course, that was deliberately intended to slow the economy. And of course, the rising rates within the mortgage industry followed suit. So late 2022, we're in the fall months, and rates in the mortgage rates started spiking pretty precipitously. I mean, we went from 2.5% early in 22. I think we closed out 2022 at rates well in excess of 6% by the end of the year. And then, as you recall, early 2023, we eclipsed 7%. So what I did as the rates started rising, I started helping these. So recognizing that there is a problem, right? So all of a sudden, my buyers came to me and they said, Mike, I'm a little frustrated now. The lender I was talking to just quoted me, 6.25% or 6.5% to take out a new loan. And 6 months ago, I could buy a house with 2.5%. And I'm like, yeah, I mean, that's just the nature of how it works. And then I realized, especially when I started working with my military families, I said, well, hold on, there's a lot of opportunity here, because every VA loan comes with a clause that allows the buyer to assume the existing mortgage. And I realized, well, why don't we start looking for these properties for you? And I started using that language just on my own. I said, well, hey, what if we can find you a home with a low rate, sub 3% assumable mortgage? Would you be interested? And these are buyers that are like, well, we're going to rent, really don't want to take out a 6.5% mortgage, or, when it approached 7%, nobody was in buying mode. Everybody was all on the sidelines. And I said, well, would you be interested if I could help you buy a home with a 2.5 or sub 3%. And all of a sudden everybody's eyes lit up. So, well, heck yeah, if you can make that happen for us, we would be all over it. And so I set out to research, how do I find these properties? Where do these properties exist? And I went into Bright, right? Because Bright's our local MLS. And I started looking at ways I can filter out properties based on the mortgage that they have. And there was no means to do that. There was no way, even today, where you can use Bright MLS to filter based on the mortgage type that the seller has on that property. I contacted the Bright product support and I talked with like their supervisors, and they said, no, that's not a feature we're building in. Sorry, too bad, so sad. We can't help you. It's not something that we will be able to provide. So then I looked at some commercial solutions, and I looked at ways where maybe I can subscribe to some service or pay for something that gives me access to this data. And that didn't exist either. There was nothing available to do this, to solve this problem. So I said, well, let me build my own platform. Like, I knew how to get access to the data, and I knew how to package it up and portray it in a way where people would want to be and need to be able to search for it. So that was the genesis behind Assume List. And really starting in fall of 2022, I launched actually it was spring of 2023. I launched a beta version of Assume List in our local market, in the Northern Virginia, DC, Southern Maryland market. And it took off right away. I mean, people were coming out of the woodworks. Mike, I heard about this new platform. We did a press release, and people really wanted to get access to it. So we've been growing it and growing it. Right now, we're in over 17 states. We just got approval for North Carolina yesterday. We're in Texas, Colorado, California, Florida, Nevada. Up and down the entirety of the Bright MLS. From Jersey all the way down to Virginia. We're in the Virginia Beach market. We're in Florida. We're in 4 or 5 different MLSs in Florida. And there's no shortage of people out there that are interested. What's strange, not strange, but what this audience might like to hear is what this really does. And somebody told this to me the other day, and it kind of stuck with me. They said, Mike, you know what you did? You built a time machine. Like, you are able to help people buy homes using interest rates that no longer exist. And so you're turning back the clock, especially for investors who need those low interest rates to make the debt to income ratios make sense, right? Because obviously, if you're buying an investment property, if the debt payments so far exceed what you can generate in rental income, it just makes it non-tenable, right? And especially in our market here in Virginia, where home prices already are pretty substantial, and when you tack on 6-7% interest rates, it almost doubles the monthly mortgage payment relative to what they were 2 years ago. Just a fun little fact for you: for every 1% change in interest rate on a mortgage, roughly equates to a 10% change in the mortgage payment. So to go from a 7% mortgage to a 3% mortgage, assuming a 3% mortgage, that basically is a 40% drop in your mortgage payment. It's pretty substantial when we start talking about the dollars tied to those percentages. So, in Northern Virginia, where the average single family home might sell for, $900,000, you got somebody with a VA loan, maybe they put 5 or 10% down, and they might have a $7,000 a month mortgage payment, or even an $8,000 a month mortgage payment. That same home, assuming that mortgage with a 2.5 or 2.75, it may only have a $3,500 or $4,000 mortgage payment versus a $7,000 or $7,500. So, and that's every month. I mean, I've had clients where they literally are saving $40,000 a year in interest due to the savings that they're making through the assumption process. So it's pretty substantial. The savings are amazing. It sounds great. It's a good talking point. So what are the pitfalls? Like, what are the things to be aware of, right? So let's talk through what are the questions that need to be asked when we talk about assumptions. So the first one right off the bat is we always have to discuss the down payment requirement when we talk about assumptions. With new loans, new originations, as you all know, the buyer gets to choose the down payment that they want to go with for that purchase. Well, with an assumption, that down payment has already been defined for you. It's already been decided. You can't change the down payment. It's based on the difference between the loan balance, which is what you're assuming, and the sales price, which you're paying for the house. So whatever that delta is, that gap, is what is the down payment. Of course, it changes from property to property based on how long the homeowner has owned the property, what they put down when they bought it. you know, how much equity they have in the property, right? All of those factors go into what ultimately the new assuming buyer would need to come up with to assume that existing loan. Key point with assumptions, with all assumptions, whether it's VA, FHA, or USDA, and for the most part, USDA is very, very rare. I've never done one. I don't think there are any, at least none that I've seen in Virginia. There's typically rural areas around the country. So we will, for the most part, only see FHA and VA. And the, forget where I was going with this. So yeah, so we've got down payment requirements. Oh, this is what I'm going to say. The down payment is defined for you. So regardless of whether you want to put down more or you don't, you know, you have to purchase the home with the existing mortgage in its current form, which means not only do you get to keep the same interest rate and you get to keep the same principal and interest payment, you also get to keep whatever the remaining length is on that mortgage. So a property that was purchased in 2020 and now it's 2024, you are assuming a 26-year remaining mortgage, not a 30-year mortgage. So the first 4 years of interest has already been paid for you. And so you're assuming now whatever's remaining left on that term is exactly where you're falling in on. You cannot add money to a down payment during an assumption, and you can't add to the loan itself. You can't reduce that amount and get approved for higher. It has to be based on the current loan balance as it sits today. Some other facts when we talk about assumable mortgages. So there's, in our area, we talked about two types, FHA and VA. There are some rule differences between the two. With FHA mortgages, they are required to be assumed as a primary residence. They do require an ownership or owner occupancy. There's an owner occupancy requirement mandated by HUD for all FHA properties. So if you're an investor, you're looking to invest in assumable mortgages, FHA is not going to be your go-to because, of course, you'd be required to move into it. And the kind of the rule of thumb is that there's a form as part of your closing documents that you agree to live in it for a period of at least 12 months. Now, I've heard that's kind of soft number. You know, certainly if you lived there for a few months and then needed to move because of work or something else and you wanted to rent it out thereafter, I've been told that's fair game. But the expectation from the lender and what you're agreeing to at the front end is that you're going to move into it and live in the home for 12 months. And then thereafter, the home can become a rental property. But you can't purchase or assume an FHA mortgage as an investment property. Let's switch to now VA. So VA mortgages, of course, managed by the Department of Veteran Affairs. There's two ways to assume a VA loan. And what it comes down to is, just to kind of set the stage here, is that all VA mortgages require some veteran's entitlement tied to that loan itself. So a veteran's entitlement has to be tied to it. When a veteran takes out a new mortgage, of course, they have to use their own entitlement. They are originating a new loan. But when a assumption deal becomes available, the assumption can either be the buyer's entitlement or the seller's entitlement. So there's an option. Now, what it really comes down to is, one, does the buyer have their own entitlement? If they don't, you can still assume it, but in that scenario, remember, because somebody's entitlement has to stay with the property. So if the buyer is not a veteran, or we're going to talk about if you want to assume a mortgage as a investment property. So in either of those two scenarios, the only way that can occur is the seller needs to be willing to leave their entitlement with the home. And what I found in at least our market, certainly Northern Virginia, I'm a little less familiar with Fredericksburg, but I would suspect it's probably very similar, is about half of all sellers that are selling a home with a VA assumable mortgage, half are willing to leave their entitlement and the other half need it for a future purchase. And so I can give you the three most common scenarios why a seller would be willing to leave it. And this is, a lot of agents and people would say, oh, no, sellers are never willing to leave their entitlement. Like, well, yes, they are. I get a classic example. I've got 5 VA homes under contract today right now. 3 of them, the seller is leaving their entitlement. So kind of right in line with the 50% rule. Now that's different in other markets like Colorado Springs, military bases, San Diego, where there's a lot of younger active duty personnel. Typically, you'll see they're more inclined to keep it. because they need it for a future use or maybe early in their career. So going back to those three common scenarios, at least in the Northern Virginia, and I say Northern Virginia, really Fredericksburg on north, to include DC and even Southern Maryland. What I have seen, experienced, and what I've talked with other agents, the three common scenarios in which why sellers are generally willing to leave it. One, first and foremost, is the equity that a lot of homeowners have in this market is really, really high. So you have a lot of sellers who are selling their homes and they've owned it for 4, 5, 6, 7 years. And remember, we've had 10%, in many cases, 10% year over year appreciation. So from last year to this year, let's just say you have an $800,000 home. Well, that $800,000 home last year is an $880,000 home this year. So multiply that over 3 or 4 or 5 years. And I think the average appreciation of the last 5 years is somewhere around 7 or 8%. So annually, right? 7 or 8% every year on average, right? So if you look at a 5-year trend line, somebody who bought a home for, say, $650,000 5 years ago, I mean, that's a potentially $900,000 home today, give or take, right? So now you're talking about that gap that we just talked about creates a massive amount of equity that these sellers have in their properties. And so that first scenario is a lot of these homeowners are selling these homes and then they're walking away with $350,000 cash, and they're moving into a low cost area, and they may be able to buy their next home straight outright with cash. So they don't need their entitlement because maybe they're moving out to the Midwest to live near family. Maybe they're moving further out west in the Shenandoah or in Richmond, southern central Florida, or even in eastern Virginia, Norfolk, Virginia Beach, Chesapeake area, where you can very easily find a very nice home for $250,000, $300,000, $350,000. And so a lot of these sellers that are moving out of Northern Virginia have so much cash and equity in their properties, they don't need to take out a mortgage because they're going to buy it cash. The second scenario is a lot of sellers, especially in our markets, VA particularly, own a lot of properties that they've accumulated over the course of their career. They were stationed in California, they bought a home. They were stationed in Texas, they bought a home. They were stationed in North Carolina, they bought a home, right? So now they've lived in Virginia for the last 4 or 5 years. They're retiring. They already own 3 or 4 of the properties, or maybe even just 1 or 2, and they plan to move back into one of their other properties. And so they don't need to keep their entitlement because they're just moving into another property they already own. Perhaps they've already refinanced it over the last couple of years. And so they were willing to leave their entitlement with that Virginia home because the home that they're moving into is already theirs. And then the third one is kind of that retirement scenario. A lot of cases, this is a really popular one, where you have homeowners who are maybe they're retiring or elderly and they're moving in with family. A lot of homes in this area, these multi-generational properties, a lot of newer properties have these massive 5, 6 bedroom, 4, 5,000 square foot homes. And so they're taking their equity and they're buying a home with family members, or maybe they're just moving into a property with family. Maybe they already own the property. And so they have no intention of using their VA equity or the VA entitlement for future use because they're retiring, maybe they're elderly, and they're just moving into a property with family. And so again, they have no reason to retain that entitlement going forward. And so that's another classic example. So really, those are the 3 common ones. There's some other ones that, if you really want to know some other options, but generally speaking, what I always do for my clients, whether they're buying a home for themselves or investors, is before we waste our time in looking at specific homes, I always just pick up the phone, call the listing agent and say, hey, I've got a buyer interested in your property with an assumable mortgage. Is your seller willing to leave their entitlement? Yes or no? And about half the time it's yes, and half the time it's no. Sometimes the seller's like, well, they're not really interested, but for the right price or the right offer, they would consider it. Okay, well, at least you got a start point, right? How bad do you want that home? Realistically, what type of offer do you need to put in? The longer home has been on the market, the better chances you have to getting an assumption deal approved or accepted by the seller. So I think that covers the basics of the FHA versus VA. We can talk about strategy and offer strategy and escalations if we really want to go into the weeds there. For the most part, cover the gap. And if you want to talk about like second mortgages, we can talk about that. But really for investors, the key to investors is we're looking at specifically VA loans, and we're looking at properties where the seller is willing to leave their entitlement because that's the only way they can be purchased as an investment property. And when that happens, they can be listed for rent on day one, and you can rent them out, and there's no ownership occupancy requirement because you're not taking out a new loan and there's no new VA entitlement tied to it. So the VA entitlement rules don't apply. When veterans do use their entitlement during an assumption, it's what's called a substitution of entitlements. When that occurs, that does trigger that buyer to move into the property because they're using their entitlement and have to adhere to the VA guidelines for a new loan. But when you're assuming an existing loan where the seller's entitlement stays, then from the lender standpoint and from the VA standpoint, there's no new rules that kick in. Just like the original seller can rent that home out, well, the buyers can rent that home out too because there's no reset in the entitlement equation.
Makes sense.
Gotcha. I think it'd be a good idea to talk about that second because they've got to think about where that gap money is going to come from, right?
Yeah, so I always recommend buyers, particularly investors. Investors generally have a little bit more cash to play with. Maybe they're rolling money in. So the other thing about investing in assumable loans to be aware of, with both FHA and VA, but we'll just go with VA since that's predominantly what we're talking about here, is you cannot purchase a home with a VA mortgage in an LLC. It has to be either in a personally owned, so in your name, or it can be in a trust. But it can't be purchased into an LLC. So your typical, investment properties where you buy it and the LLC is on title does not work. It's not allowed per VA guidelines, which also means I've never seen a VA loan. You can't 1031 VA either. Because they're intended to be a primary residence. They're not meant to be investment properties. So when we use the word investments with VA assumptions, we're generally meaning it's a rental property. And there's nothing precluding you from renting out a home with a VA mortgage. They are not designed to be quote unquote purchased and utilized as investment properties. So there are some restrictions, again, ownership being one of them, and also 1031 and some of the tax implications, although I think some of those can be work through when you start using trusts, and you really got to talk with an accountant to learn the details. But that's something just to be aware of. Nothing stopping you from depreciating it. There's nothing stopping you from renting it out. Certainly the expensing, all the ownership costs and mortgage interest, all that's the same. But when it comes time to do 1031s, when you're rolling stuff, I don't think those are possible with VA loans because they're not, the VA doesn't recognize them as investment properties. About second mortgages. Second mortgages are generally tricky to use with any assumption, regardless of whether VA or FHA, for two primary reasons. First and foremost, not all lenders allow second mortgages. So depending on who the servicer is or lender, you'll hear that term interchangeably. That whoever's servicing or managing that VA loan or the FHA loan, let's go with VA. The servicer may or may not allow second mortgages. It's part of their own internal policy with how they manage their loans. And so when you do an assumption, they have no choice. So kind of a dispelling some myths here. You may have heard some rumors or talked to a buddy or heard it from an agent that some lenders don't allow more assumptions on VA loans because for whatever reason they're too busy. They don't want to process them. False, false, false. By law, lenders don't have a choice. They are obligated to process an assumption if requested by a veteran. Veteran could be the buyer or the seller. So the only stipulation or the only role the lender has in approving or declining an assumption is whether or not the buyer is financially qualified. So as long as the buyer is financially qualified, meaning they have the right debt to income ratio, they have the right credit score, right, sufficient income. So the same VA guidelines to originate that loan applies to a assumption. So as long as that borrower meets the financial qualifications, that assumption will be approved. That's the only way the lender can decline an assumption. The other way, of course, is if there's a disagreement about entitlement. Obviously, if the seller says, no, you're not going to use my entitlement, and the buyer doesn't have one, obviously that would be a decline. But you would never go that far because the contract will have already stipulated that before it even gets submitted to the lender. So in all of our contracts, we include a VA assumption addendum, and it spells out the terms of the assumption, whose entitlement is going to be used, what happens with the escrow funds, all of those things are all spelled out in the contract. So theoretically, I guess, yes, if the buyer doesn't have entitlement and the seller says no, then, that would be a non-starter. But generally speaking, lenders can only decline an assumption if the borrower is not qualified, which is why we always recommend borrowers to get a pre-approval letter from any reputable lender before they submit an offer, because ultimately the seller needs something to show that you're not wasting your time and wasting their time, and that you're financially qualified to purchase the home. So if you can get a pre-approval letter, because most lenders will issue a pre-approval letter with current rates. So if you're looking to buy a home at $600,000 and you can get a pre-approval letter at 6.5% interest for $600,000, well, it's a whole lot easier than to assume that loan with a 2.5% mortgage, because the ratios are much more favorable with the lower interest rate. But you always get a pre-approval letter to demonstrate financial qualification, and as long as you can be financially qualify, the lender will approve because they have no choice. Second mortgages, we'll touch on these pretty quickly. Again, not all lenders allow them. The other scenario, or the other factor that comes into play, is sometimes sellers dissuade or don't want to pursue those, or will kind of just say, hey, you're not really interested in that, because it adds a layer of complexity. It adds more time. It adds more risk to the transaction. Ultimately, the seller just wants to close the home and sell as quickly as possible, get the most amount of money, and they don't want to be dicking around, excuse me, but messing around with all these lenders' approvals and getting all these red tape. And the biggest one, of course, is second mortgage holders will require an appraisal, and a traditional assumption without having to use a second. There is no appraisal involved, so just much cleaner, simpler process. And so a lot of sellers, and I've won deals where I've put an offer in to assume a home, and there was another offer to assume the home. And of course, if the other offer had a second mortgage requirement, which in this case it did, the seller clearly went with me because it was a much cleaner, easier, less risky proposition. And so it just adds a layer of complexity to an otherwise complex transaction to begin with. And so you may find that to be cumbersome. However, if the seller just needs to get the home sold, maybe the home's been on the market for 30 days or longer, and they're going to take whatever they can get, and the buyer just happens to need that second mortgage and is qualified to get it, there's nothing stopping you from doing it. Again, that you'd want to check with the listing agent just to verify that the servicer who manages that loan does allow second mortgages. Most of them do. The major banks do. I know like PennyMac, Freedom Mortgage does. There's some smaller banks. I was told Pentagon Federal Credit Union does not on their VA assumptions. I don't have the exhaustive list. I mean, there's dozens of lenders out there. I would say somewhere between 50% and 75% of lenders do, and then somewhere between 25%, maybe up to 50%. I don't have all the metrics on this. Do not. So just keep that in mind if you are looking to pursue a second mortgage. The other factor is keep in consideration the second mortgage amount can't cover the full 100% of the loan. Generally speaking, and there's not many lenders who approve or originate second loans. So most credit unions won't, most banks and loan originators won't. You got to go to a specialty shop. And so I've got one that I work with that does do them. But generally speaking, they're going to require at least 10% down. So you're only going to get 90% loan to value. So whatever that purchase price is, 10% of that's got to be covered by the buyer. And then the delta can be picked up by the second mortgage. So just keep that in mind as well. And they're generally, somewhere around 9 or 10% interest rates. So you really want to keep that second mortgage balance down as low as possible, because then you're chewing into the savings that you're gaining from that primary. So there's a blended rate that's created when you include a second mortgage. And what I generally do is I will calculate or find out what the current principal and interest payment is on the first mortgage, or run a quick scenario to calculate what the second mortgage payment is if it's needed. Combine those two numbers, and if that combined payment is lower than taking out a new loan, then it still makes sense to assume it. But the bigger that second mortgage is, then it's skewing the savings from the primary. At some point, there's going to be a crossover, and that mortgage payment on the assumption is going to actually cost more than if you were just to take out a new loan, especially today when interest rates have dropped precipitously over the last week or so.
Right. So
So
Michael, when can you get into your product and how it's best used? I don't know if you have an example or if you can take us through one or
yeah,
and
let's do this. So assumeless.com. So here's the website, assumeless.com. Find homes for sale with assumed mortgages. So this is built by agents. You know, I built it. It's my platform.
right,
Again, you kind of heard the story on it, but it's designed to give both consumers and real estate agents access to every assumable mortgage on the market, whether or not the listing agent has even knowledge of their home is assumable. In fact, what I find is about half, which blows my mind, half of all listing agents who list a home for sale with an assumed mortgage don't even know that their property is assumable. And
right.
only about
Believe
10%
that.
of homes with assumable mortgages have comments in the description in the listing. So, if, you know, a lot of people said, oh, just go to Zillow and just do a keyword search. Well, yeah, you can keyword search about 10% of homes with an assumable mortgage, but what about those other 90%? Like, you're missing out on those. Here's the areas served that we cover. So these are all the states that we're in, and then I highlighted the counties in which we provide direct access to, and this is based on MLS access. So as you can see, we're in all of northern and central Virginia, and then we do cover down here eastern Virginia, Hampton Roads area as well. And then you can always go through all the other states that we service. We include all of Washington D.C., the entire state of Maryland. You know, if you got anybody looking to buy homes in Florida, so we cover, you know, most of central southern Florida and Jacksonville, Florida area. Colorado, California, Arizona. So you can go through this if you are interested in kind of seeing where we cover. What's really cool is if you have an account, you can actually search all of these areas. I don't restrict it based on location where you are. There is a difference between, there's two types of accounts. There's consumer accounts / investor accounts, and then there's agent accounts. The difference is agents have access to off-market properties. So I do give them the ability to search for properties that are off market, where consumers will only be able to display homes that are actively listed for sale. I'll just quickly we'll do a quick search here. I just want to show you what the dashboard looks like. When you log in, the point on the dashboard that I wanted to point out here is that when you log in, you'll see a list of all the properties that we have in each of their statuses with that are assumable. And a lot of people complain that, oh, well, there's really no homes for sale with assumable mortgages. You know, they don't really exist. Well, just, you know, you can filter it based on the state, but we'll just click on Virginia. So just right now, in that, you know, Northern Virginia and then the Virginia Beach market, just those two small little areas, there's over 1,000 assumable homes for sale in active status right now today. What we also built into this platform is we only display homes with assumable mortgages with an interest rate of less than 5%. So I don't care if somebody bought a home with a VA loan 6 months ago or a year ago and it has a 6.25% interest rate. Nobody's going to assume that. You can get a better rate today. So I'm not going to display all homes with assumable mortgages. I'm going to display homes with assumed mortgages that are desirable and feasible to assume, which means in my book, sub 5%. The vast majority will be in the 2s and the 3s. In fact, I think about 75 to 80% of all homes on our website have an interest rate of 3% or lower. The other cool thing that we show is a trend line. Let me just change this to Virginia. I'll explain why the red line is here, but the trend line, the green line corresponds to the green line on the left. So this is a snapshot in time today. So right now, today, there's 1,130 homes in Virginia, at least in the market that we cover with assumable mortgages. And this goes to show how that trend has changed all the way back from March of this year. We started recording this, June, July, August, you know, into August now. And you can clearly see, this is the only place that I'm aware of that shows how inventory, assumable mortgage inventory, has been steadily increasing week over week since at least we've been recording this data since March. The red line and the green line also correspond to these. We actually had to reset our data in mid-July because we were getting fed some erroneous data, so it was reporting bad data. So we had to reset the under contract line and the active or the coming soon data. But you know, this just gives you a trend of coming soon and pending But the important one is the trend for active. And so what this does demonstrate is that assumable inventory has definitely been getting better, and that's common across the country. So here's California. I guess we'll look at Maryland. So Maryland inventory definitely gone up over the last few months. In Florida, the same. So you can see that across the board, inventory, and you probably know this if you're looking at the industry, inventory has gone up, but assumable inventory is also gone up. Let's run a quick search. So this is the actual search page. We're just going to go, you said Anna, Fredericksburg is the common area. So we'll just type in Fredericksburg. We can just partially spell it. You can search by city, you can search by county. So Frederick, Maryland, Frederick, Virginia, Fredericksburg City. You can search by zip code. You can search by neighborhood. You can actually type in an MLS ID number. It'll find properties based on MLS ID. Or you can search by a specific property address. So if you wanted to type in a street name, or if you knew the actual street, you can just enter that in as well. For the purposes of this demonstration, let's just go with Fredericksburg, Virginia. And so we'll just kind of see what we find here in Fredericksburg, Virginia, right? So here's a list of all properties in Fredericksburg, Virginia that are listed in the MLS with an assumable mortgage. It doesn't require the listing agent to comment or mention that it's assumable. There's 84 homes, and the first thing I like to do is just filter to only look at active and coming soon. If you really wanted to see homes that are under contract or pending, we include them because sometimes the contracts fall out, and so some people I know track this information. So, or if a home went under contract, they still want to be able to access it to see what the interest rate was. So we do allow people to search for properties in those other statuses, but when we actually are running searches, we really want to look at what's available to us. So just with a Fredericksburg, Virginia address, right now there's 36 properties that are purchased, can be purchased today with an assumable mortgage. You can filter based on price, you can filter based on when it was listed. I often filter based on down payment. And then we can go through these. Now, there's other filters up top. We can filter, only look at single family. Let's just say we only want to look at single family. So we're eliminating townhouses, and you can set based on bedrooms or bathrooms. If you wanted to do that, you can also set filters based on the purchase price. So if you wanted to set a certain limit on max purchase price, you can do that. If you want to set a max limit on what your max mortgage payment is that you're looking for, or if you're an agent and you're helping a client, you can set up filters based on mortgage payment. But I think the most powerful feature here is the down payment filter. So if you only have X amount of money available, you can set your filter based on that cash requirement. So let's just say there's 28 homes across the board that are single family in active status in Fredericksburg. Let's just say we have a buyer that has no more than 200,000 down. So that will go down to 6, right? So we have 6 properties that at least conform to all of those specific criteria. What we could do is, we'll go through these in a second, but you could also set this up as a saved search, and we could just call this whatever we wanted to, Fredericksburg, single family, and yeah, 100, whatever you want, 200K. And then you can save this, you can set this up and have automatic alerts. So whenever a property gets listed for sale that matches this criteria, you will automatically receive an email notification informing you that there's a new listing that came up that's assumable with an interest rate of less than 5% that matches this exact criteria in Fredericksburg, less than 200,000 down. That's a single family home. And so you can receive those email notifications specifically tied to your search criteria for assumable homes. Let's just open up one of these. So Wisteria Drive in Fredericksburg. Let's just open this up. I think I used to live on Wisteria Drive. I live down, this is Lee, is this Lee District? Arbor Glen. So what you'll notice is it tells you the status, it tells you the property address, it tells you the list price. What's really cool is we also tell you the down payment amount. So we get that from the loan balance. And then we run the math for you. We take the difference between the loan balance and the sales price. So this home is going to require roughly is $96,000 down. It is FHA, and it's got a 2.59%. And sometimes they will, if the agent provides this to us, we will strip it out of the text. Like I said, only 10% of agents do that. So without being informed exactly what it is, we have to kind of back into it. So we have some algorithms that really get close And for the most part, we're usually accurate to within plus or minus about 1/4%. So I'm guessing this home either has, 2.59 is not a common interest rate. This home either has probably a 2.5 or a 2.625 or maybe a 2.75. But one of those three scenarios is most likely what this home has in terms of the actual interest rate. But this gives you a really close enough assessment. We also run a mortgage payment calculation. So this is principal, interest, and taxes. This does not include insurance, because insurance is usually pretty unique to owners based on their history and claims and stuff like that. So, but this has a really low mortgage payment. The home was purchased in August of 2021. It does not appear as though they had refinanced it. If they did, it would display the refinance date. This home was just listed, so one day online, 3 bedrooms, 2.5 baths. We do some calculations here. Price per square foot. Built in 2020 or built in 2002. It's an HOA, $25 a month. So a lot of the stuff gets pulled from the MLS. But what's really important is that we provide this additive value to educate consumers or agents on what the loan terms are. And of course, you can go through all the photos because they're all tied back to what's being provided to us by the MLS. And of course, if there's a 3D tour, we can actually access that from here as well.
That's a very cool tool.
Yeah, if there's a
pretty
price
cool.
reduction, we'll show the price reduction. So it looks like this home was previously in April of 2024. It looks like it was listed for $365. I wonder if they pulled it off the market and did some renovations. Oh, there we go. Yeah, it looks like they definitely did some renovations. The home looks like it's really nice. So I would imagine they probably did some work on it and then relisted it at a higher price point. Or maybe the investor is flipping this home, but I can't imagine that being the case because they wouldn't be able to flip it with an FHA. That would be a little difficult to do. Let's just look at one more, just while we're here. Let's go. I don't know if you guys have any thoughts here. Let's find one, a little higher down payment. So Lafayette Boulevard, I guess this is downtown, right? I think Lafayette's downtown. So I used to live in Fredericksburg years ago. Loan balance 330, has $180,000 down, interest rate of 3.94. For some reason, this one is actually not displaying a mortgage payment. Sometimes that's provided to us. Sometimes we have to calculate it. I have to go back and see why we're not able to pull that data.
That's maybe because it's a newer home.
It was built in 2014.
Oh, wait a minute. No, it says 2014.
Yep, and it was purchased.
Oh, on Lafayette. That's interesting.
Original
I was
owners.
thinking one in the new neighborhoods there.
Yep. Listed for $511. So it's been on the market for 28 days. They have not done a price reduction since it was listed. So interesting.
Might be ripe for an assumption.
Ripe for an assumption, yes, VA. So maybe they're open to, certainly probably open to a price adjustment. Maybe they're open to leaving their entitlement as well. So these are what I look for. It's got a Tesla charger in the garage. Down here at the bottom, agents will have access to this. You can, contact, not that you need to, but we provide owner information. And then we do have a skip tracing tool where if I click on this button, I'll just demonstrate it for you. It should provide us with the homeowner information. This is specifically available to agents. So Jimmy McKinney, we've got some email addresses and some phone numbers. So if we wanted to contact them, we can do it. And it does look like this is a rental property. It's absentee owner. Owner's not owner occupied. So it is a rental property, and the tax records show that the owners live in Vegas. So this definitely looks like it's a rental property. So maybe they don't need their entitlement. So that might be one that you can consider looking into. So I'll kind of stop there. You guys get an idea of how the tool works. You can set up alerts like I talked about. You can set up criteria. You can, this is a full Google Maps interface. You can set up a custom, if you only want to look at like the downtown area, you can set up a custom polygon and only look at properties inside of a polygon. So that's all, it's all, kind of customizable, and you can set up notifications even based on the custom polygon. You can filter based on zip code. So if you want to look at just properties in a specific zip code, you can set zip codes up. You can look at multiple zip codes. So if you only want to consider 22401 and 22408, then you can just do that. And now it's only showing those two zip codes and not all of Fredericksburg, or you can do.
Can you look at just that VA loans? Are you able
Yes,
just to?
yes, you can. So let's just go back out. I'll just do Fredericksburg, or do you want to do like all of Spotsylvania? Let's just do something broader, right? So Spotsylvania, right, county. So let's just go all of Spotsylvania County. And there are, let's see here, active coming soon. Let's just do everything. Let's just kind of set this filter. So 55 properties. And we have a filter under the More tab where you can filter based on the loan type. So if you only wanted to look at VA, there's nothing that's going to be USDA, so that number didn't change. But let's just eliminate FHA, and we go from 55 to 35. So, if I flip this, it should say 25 or 20, yeah, 20. So this market, it's about, 3/5 VA, 2/5 FHA. So, and generally speaking, we're going to be much more heavily weighted in the I-95 corridor towards VA because of the proximity to the Pentagon and Quantico and Fort Belvoir and all the military bases. There's a lot of high concentration of military families. So you'll see there's be higher than 50% of all assumable mortgages in our area will be VA. And the other thing I've noticed is single family homes will generally be more VA, where condos and sometimes even lower cost townhouses will predominantly be more FHA. So just something I factored in. And that's just based on the fact that, remember, people that are using FHA mortgages likely aren't veterans, so they don't have that option, and they won't use a conventional because they don't have enough down payment to cover the conventional mortgage. So they're generally going to be using FHA for the lower down payment requirement. And those are typically people that are not buying, $1 million single family home. They're generally buying lesser expensive homes because of that lower cash requirement to do so. Any other questions?
So, Mike, if they wanted to sign up for this service, they could email you at mike@assumelist.com.
They can just go to assumelist.com. Anybody has any questions? Yes, email me at mike@assumelist.com. But if you just go to assumelist.com, you can go right to the pricing page and sign up today. It is ready to go. And what I'm going to do something special for you guys is I'm going to give you a coupon code for 10% off. So there's three ways to subscribe. There's a basic plan, which will give you access to every single mortgage, VA, FHA loan, but it doesn't provide all the core details of the loan balance, interest rate, mortgage payment, and that's $19 a month. So value there, but it's very inexpensive. For $49 a month, you get access to the Pro account. I think that's a remarkable value because now you get access to every home in the market, plus you get all the details about the loan, the down payment requirements. You can set up filters, like you can filter between VA and FHA. So if you're going to save, $1,000 a month in interest every month, I think $49 is a very reasonable, modest amount to spend to get access to that. It's the only place that I know of where this is available. And for agents, there's a monthly fee of $79. And the difference is agents get a lot more tools to do some marketing. They can create branded landing pages so that when they send properties listings to their clients, those pages are branded back to them with their contact information, their logo. They can use it to lead generate off of with social media. And also the key point is agents also have access to off-market homes as well. So if they wanted to, pull a list of all properties that are in a specific neighborhood and there's nothing for sale, they can just list every single off-market property and then use that built-in skip tracing tool to contact homeowners and ask them if they're interested in, accepting an offer to assume their mortgage.
Very cool.
So do you want to email me that link, Michael, for the discount?
Yeah,
or do you
it's actually just a coupon code. So when they go to their cart, they will be they'll be in the let me see. Let me just pull it up real quick. Just give me 1 second. Give me 1 second here. I'm going to pull that up and then I'll share my screen again. And let me just get the coupon code. We'll put this in the comments here. Then you can also, if you wanted to send it out via email to your team, I'll give you a code. Or you guys want me to create a custom code for you, but we can use an existing one.
It doesn't matter. It doesn't matter. I just didn't know how you wanted to send it out.
Here, I'll just give you one. Let's go with give 10 off, and I'll give you 10% off any subscription.
10 spelled out?
I just posted it in the chat.
Oh, okay, got it. Great. I'll copy and paste that.
Yep. I don't know why there's a link there. There shouldn't be a link, but it just give 10 off. And then when people check out, there's on the cart, they'll be, given the opportunity to enter that code. So let me just go ahead and I'll share my screen here one more time, just to wrap up. So we've got, this is the pricing page, so you can subscribe monthly, or if you're going to be doing this for a while, you can get 2 months free by signing up on the annual plan. And this is what I was talking about earlier, the 3 different options. If you're a team, certainly I'm happy to talk to you about team setup, but essential, pro, and agent. And then down below we have all of the different options that come with each of the loan types, or of the plan types. For anybody who's interested, and they can certainly contact me if they have any questions. When you go to the checkout, you just enter the coupon code here, and it should give 10 off. It'll automatically, I think I checked on the pro, it'll automatically apply 10% off coupon, and that'll just be a reoccurring for as long as your account's in place.
Excellent. Very cool. Very cool product.
Awesome. Yeah. I'm glad to answer any questions. I've been running my mouth for a while here, so I'll take a break and turn it back over to you, Anna.
You're doing great. You're doing great. So does anyone have any other questions for Michael? I know Lynn and Michael Connell on here. Rick, did you have any?
Well, we've done some, I'll call them bootleg assumptions. Sometimes they've been wraps. Sometimes they've been. This is really a cool way to get at it. I remember exploring this, looking at it was very cumbersome. You'd have to go to the closed sales and see how they had closed the sale, what kind of financing terms. And this really provides an easier way to get at that information, especially, when you could see what is currently for sale and what their terms were. So this is so much more powerful than the way I was going about it. Before Bright, I think it was MRIS, but I was trying to look at old data to see how they had closed
the only way, there's a lot of agents that still do that, and frankly that's the only way to do it without a SUM list, is you have to, and you can only do it one property at a time. So if you had a client that says, hey, send me a list of all homes in Fredericksburg that have a single mortgage, there's no way to do that with what you just described. You have to literally go in every active listing, pull open the last closing, the last transaction, and see what type of loan was used with the mortgage type in the previous closed transaction, one at a time. There's no easy way to do that. And what Assumus does is you can set your filter across an entire county, zip code, city, and see everything all at once, and set your filters. It's just so much more powerful. And the other thing you mentioned is a lot of people get subject to confused with assumptions. So these are not subject to. Buyers actually own these properties. They're retitled in the buyer's names. The seller has no obligation or liability post closing. So they are completely disconnected from the mortgage. If that new buyer forecloses, the seller doesn't reinstate the loan. Like, it is disconnected as if it was a clean transaction like any other property. The only scenario in which a seller may still be tied to the property is if they leave their entitlement. But the entitlement is separate. This is very important. Is separate from liability, responsibility from the mortgage. So there's 2 separate distinctions. There's liability, mortgage liability, and then there's entitlement, which is strictly with the VA. So every assumption, whether it's VA or FHA, the seller is completely disconnected from the loan, never has any responsibility to that loan again. So if the buyer's default, the original seller's credit score does not take an impact. They are disconnected from the property. If the buyer uses their own entitlements, or with an FHA there is no entitlement, then the seller has no obligations to the property or responsibility for anything or any ties to it. If the seller leaves their entitlement, the only thing they have in that property is their entitlement. So a lot of people, so here's the last thing I'm going to leave everyone with, because this is a very important thing. A lot of agents will say, well, sellers should never leave their entitlement, because what happens if the buyer defaults? Well, if a seller's already decided to leave their entitlement, who cares? Because they've already decided to leave their entitlement. They've already left. They've already made the decision that they don't need it. So there shouldn't be any expectation that they're going to get it back in 2 years or 5 years, and there's no obligation or the requirement for the buyers to refinance down the road for that seller to have their entitlement reinstated. So when a seller makes that decision before the offer is accepted, whatever happens thereafter, if they don't need their entitlement, it doesn't matter if the buyer defaults, doesn't default, pays the mortgage off, doesn't pay. The seller's already decided they no longer need their entitlement. Technically speaking, yes, if the buyer does default, then the VA could basically nullify that seller's entitlement. They don't get reinstated because there's a claim on their entitlement. If the new buyer defaults and the VA has to pay out a claim to the lender for losses, then most likely that seller is not going to, that original owner whose entitlement was used is not going to be reinstated. But it doesn't really matter because they've already given up their entitlement to begin with when they sold the home to the buyer. So there was never an expectation that they would get it back anyway.
Right.
That said, I've never seen buyers are not going to default on a 2.5% assumable loan, especially in our market. I mean, what's the default rate in Northern Virginia? Like 0.001? Like I get all these new first-time home buyers saying, hey, I'm really interested in foreclosure homes because I want to get a good deal. Like, okay, you and everybody else, foreclosures don't exist in our market. Nobody defaults because they have so much equity in their property. They're going to sell it before they default. So there's no foreclosures. Buyers aren't going to default on these homes. These are just these, a lot of agents out
Hypothetical
there.
wish
Yeah.
list.
Yeah.
Awesome.
Lynn asked a question. Since the buyer is getting a lower interest rate to assume the loan, does the seller expect a higher sales price? What would motivate the seller to let the buyer assume the seller's loan? So that's a really good question. And what we find is that there's a couple of variables in place. One, the seller can just allow the buyer to buy it and not allow the entitlement. So I've got a VA listing right now in Virginia, in Alexandria, where the seller is a veteran but does not want to leave his entitlement. He wants to use it for a future purchase. We're still listing it and advertising it and marketing it as an assumable loan, but the stipulation is a buyer has to have their own entitlement in order to assume it. So the seller then just needs to make a decision. Do they want to take an assumption offer or do they not? And really what it comes down to is how quickly or how badly does the seller need to sell and what offers are they getting? If this is like the spring market and, Northern Virginia, it's not uncommon to see 6, 7, 8 offers on the same home. So you're probably going to have 2 VA, 2 conventional, maybe one's an assumption, maybe one's all cash, right? It's going to be really hard to compete with an assumption when there's all that other competition that you're competing against. So in that scenario, if there's a lot of competition, it's going to be really hard to win. Now, I just got a VA home under contract last week. It was me and one other offer, and the other offer was a 20% down conventional closing in 30 days. And they took my offer, which is an assumption. We are using our own entitlement, but the sellers wanted to sell it to another veteran, and the other buyers weren't veterans. And so the seller wanted to go to another veteran family, even though it was going to take a little bit longer, they were willing to do it. We did pay a little bit extra because the extra time it took to close, we were going to compensate them for covering their mortgage payment. So I think we offered like $10K higher. But if the bottom line though is sellers want to sell their home. So if the home's been on the market for 28 days or 30 days, like that one example we saw, they're going to take whatever offer they can get. So if you offer them, hey, I got a buyer who wants to assume your mortgage, they're going to say, okay, send me the offer. And if the offer looks good, they're going to take it. Some cases may have to offer more than asking. Usually if the home was just listed and the seller is like, well, I'm not really sure I want to take an assumption offer yet, but if you make it worth my while, maybe I'd consider it. And so in that case, you may very well want to increase the offer. But remember, that buyer, the client, whoever, if you're the buyer, you're going to be saving how much money? I usually do this calculation. How much money are you saving in that assumption mortgage payment versus taking out a new loan? If it's, $1,500 a month.
Michael, are you there?
You're thereafter.
There you go.
Why not offer?
Just a second. That's all. You're back. Yeah. Don't worry about it.
Sorry. Yeah, say why not offer more if you have $20,000? If you're saving $20,000 a year in interest, why not offer the seller a little bit more to incentivize them to take your deal? Because you're going to make up for it year 2, year 3, year 4, right? Every year you own that home, you're going to be saving $15,000, $20,000, $25,000 in interest. So if you have to give up a little bit on the front end to get the deal, why not? It's either that or not get the home. Why not? Why not give up a little bit? It's money that you would be spending otherwise if you had to take out a new mortgage. So that's just kind of the analysis that I use.
So Lynn asked another question in the chat. She said that she heard it takes about 6 months to do this. Is that
it does not
time frame?
Yeah, it does not take 6 months. So right now, depending on the servicer, I've got 2 of them closing next week. 60 days from the time they're ratified until the time we're closing. And then I'm going to do one step further. Here we go. I'm going to post a blog article in the chat. I would encourage you to read it. So the VA just released December of 2023, so about 8 months ago now, a VA circular that mandates that lenders are required to approve assumptions within 45 days. So they have to prove them within 45 days. Now, when does the clock start? Well, the clock starts whenever the buyer submits the loan application, it's not from the date of contract ratification. So from the date that the buyer submits their application to the servicer to begin that assumption process, the servicer only has 45 days to approve. And so there is no exception. They can be fined. And that blog article talks a little bit more about how those rules work. There is no equivalent rule with FHA, but I think for this audience, really what we care about is VA assumptions. So, but generally speaking, 60 days for many lenders, up to 75 for the slower lenders, but generally speaking, we're talking between 60 and 75, although there are some lenders, the time is actually getting lower and lower on a regular basis. There are some lenders right now that are actually closing in somewhere between the 30 and 45 day mark. Usually the smaller servicers can do much faster. The bigger institutions take a little bit longer. But there is no scenario in which it takes 6 months anymore. I actually did one a year and a half ago, and it took 5.5 months. That was painful. But with this new circular and a lot of the rule changes, generally speaking, we're about 60 to 75 days from the date you ratify a contract. 45 days from when the buyer submits their lender package to begin the actual assumption for the review, the underwriting review.
That's good to know. I'll include that link when I send out the recording tomorrow too. So.
Yep. And there's other articles on our website, our VA loans assumable by non-veterans, and that talks a lot about some of the rules for investment properties. There's some questions about entitlements. There's some fee updates. So there's another article about fees for assumptions. So go through the blog page, assumeless.com/blog, and you can see there's a bunch of other articles in there that you might find valuable. And by all means, if you have any questions, you can reach out to me.
This has been great, Mike.
Happy to help.
Definitely.